Well, thanks so much, everyone, for being with us here today. My name is Eric King, a senior consultant at Semler Brassi. I'll be moderating our session on getting ready for an IPO here. We have a really exciting panel. I think there'll be some really valuable insights in our various topics of IPO planning. We'll go through a few different things related to establishing a scalable compensation philosophy, designing equity plans, understanding the legal milestones, and much more. And really our goal today is just to provide key learnings, insights that can be brought forward to the upcoming compensation committee meetings as the IPO market continues to heat up. I'll just start here by having each of our panelists introduce themselves. And just as a reminder, feel free to include any questions in the chat bar. We'll try to get them as we go or at the end as we have time left over. So Jack, do you want to start just by sharing your background here?
Sure. I'm Jack Lazar. Nice to meet everybody. I'm a former CFO of multiple companies. I began doing board work full-time in 2016. I've been on a variety of different public and private boards. Today I'm on Astera Labs, Box, Global Foundries, and Residio are my public companies, and then Tonal, which is a private company in the connected fitness space.
Great. Ali, do you want to provide a quick background?
Sure. Ali Murata, and I'm a partner in the compensation and benefits practice group at Cooley. Have been practicing in this space for 25 years, and really focus on all things relating to compensation and benefits, principally in the late stage private company space, as well as public companies, M&A, IPOs.
Great. Thanks, Ali. Steve, I'll turn it over to you.
Sure. So Steve Charlebois, Managing Director with Semler here in Los Angeles. Similar to Ali, I've been doing this over 20 years and bring experience in late stage private, typically Series C, Series D companies, all the way through large cap companies, primarily in the tech and tech adjacent industries. So excited to be here.
Great. Thanks, Steve. And I'll just provide just a quick overview and then we'll get into the questions. As I mentioned, as we start, we're going to go through the different aspects related to planning for an IPO. Really, our discussion today is timely. Much slower deal flow leading up to where we stand today, and really feels like the IPO window is starting to reopen. So, companies are once again thinking about the timing is right, what to do to prepare, making sure we're considering all the investor expectations. So, we'll plan to touch on all of that through our discussion. So just with that background, just to each of you, just to kick us off here, what are you seeing in regards to the opening up of the IPO market? What should boards be thinking about from a compensation perspective? Ali, I might start with you. Do you want to go first here?
Sure. And I think the first thing, of course, that springs to mind is that our government is going to need to reopen. Otherwise, that will inhibit the opening of window. Not impossible, but certainly more complicated with, things. DC is still somewhat functioning. I think that companies need to be prepared, right, more than ever, and also need to be prepared to pivot. I think that certainly in terms of companies that are going public right now, many of them have been anticipating the window opening, and so are frankly better prepared to be public companies than we saw sort of in 2021, where frankly felt like a company just needed to think about being public, and they were.
Yeah, absolutely. A lot more planning, it feels like, going
Yes.
into this season. Steve, what about you? What are you seeing with regards to from the IPO market from your perspective?
I would just echo what Ali had to say. I think if you look at the last cycle, we took a look at the numbers, and 2020 and 2021 and specifically, I think there was over 1,000 IPOs, which dropped down to below 150 in 23. And we're back up to about 250, which is, I think, generally the norm so far this year. So definitely heating up. And I think what comes to mind for me is, if you think of that last cycle, as Ali mentioned, a lot of outsized valuations, a lot of companies going through the public markets via SPAC. And so, yes, I agree with Ali that there was really just this normal course of business. I think what I'm seeing in my client base now is really much more quality in terms of companies that are going public. So because of the backlog and because of the time the markets have been closed, companies are taking that time to basically get bigger, get stronger, more quality of earnings. And also, I think in the secondary market, there's just been a little bit more liquidity. And so the pressure and the buildup isn't quite there like it has been in the past. So from my perspective, seeing the same thing that Ali is.
That's great. Jack, what are your thoughts? Similar to those two, or anything else to add on here?
No, I think pretty similar. I think there are some nuances that are a little different that we'll probably get into in our conversations this time around. But I think generally companies are more prepared. Um, and I also think that you'll see quite a lot of private equity focused companies getting out, and there's a lot of infrastructure within private equity that really helps you prepare. So I think that's an important point that makes governance a little bit better as these companies get out public. Um, but some of these outsized valuations that you're seeing for companies when they go public now, if they're in the right spaces, can have unintended consequences to the compensation process, and I'm sure we'll speak about plenty of those.
Yeah, absolutely. Jack, I might stick with you there just as we think through some, maybe some real life examples, for yourself going through multiple IPOs. Can you provide just like your perspective from the director's side, what should we, good examples, what should we be thinking about in terms of the IPO readiness, that's top of mind for you?
Yeah, look, I think they're a wonderful experience. I've been through 10 of them, I think, and they're really fun to go through. But it's also an important point where you need to take care of the people who got you there too. And so I think directors, it's a really good opportunity to sit there and think, how can I get these people, in the seat for an extended period of time? And you get to do it at pre-IPO prices. And I think that's a win for everybody, assuming you have the right team. So I think that process hasn't changed over the years, but it's really important to be thinking about as you're going through. And then one of the other things I would say that comes out of that is it's a great opportunity to recruit people, right? So it's a good time to use compensation as a tool to get maybe some of the people that were maybe out of your league before, and if you can use comp as just you got the company is what's going to sell them, but the comp is going to get them over the bar here. So I think that is an important aspect of being ready to go public. So those are probably the two that I would point out to start.
Yeah, that's a good point, just in terms of the opportunity and the upside. A good place to start, particularly as you're looking to bring on new people. Steve, just from your side, what about an example of maybe along those lines, a great comp plan that you've seen move through an IPO? How does that work, and how does it sort of manage the needs of everyone involved, executive board members, founders, et cetera?
Yeah, I think Jack raised the points that I'd like to just echo. To me, there's nothing that's in this environment that is just boilerplate or status quo. I think context really matters. So as you think of, the questions around context, what industry are we dealing with? What's the IPO ownership, profile look like? Is it VC owned? Is it family owned? Is it late stage private owned? And also, we're also seeing an uptick in foreign listed issuers. And so, is there any local regulations or things from a tax perspective that you need to contemplate as part of the IPO? So the first thing I'd say is context really does matter. And then from there, as I think of a comp program and you think of those different inflection points around the IPO, the one thing that comes to mind is durability. You want a program that's durable over time and that's going to wear well with the inherent volatility that's within an IPO. Specific example for me that comes to mind, helped a company go public a few years ago. Private valuation went from 10 billion up to 40 billion, back down to 7 billion within a 24-month timeframe. That's a lot of volatility to handle for a pay program. So being able to manage that proactively with the different constituents and stakeholders is obviously important. The other point, which I mentioned, I'd just bring up is the ownership profile. my experience, VC firms that are early investors versus late stage private equity firms have very different profiles in terms of what they like to see in compensation programs. One is not better than the other, but just helping think through the different dynamics of your ownership structure and the influence that that's going to have on the pay program as you think about going IPO is obviously important. And then the last thing is you think about just the durability of programs and managing those different stakeholders is I like to think about it in 3 inflection points. You've got the IPO inflection point, so preparing for that, making sure that you're managing the team through that. The second inflection point is typically 3 or 4 years post-IPO, where you have a broader institutional ownership and managing that transition and proactively managing that. And then in my experience, the last transition in terms of durable pay programs that you need to be thinking about is when the evergreen position equity plan kind of runs its course 10 years post IPO. That's another inflection, just natural break points that you see in the cycle of companies that, again, you want to be managing and developing a program that's sustainable over time.
Yeah, that's great. I think the evergreen piece is particularly interesting, just in the sense of feels like it's going to be in place forever, and then all of a sudden you're at that point where you have to reevaluate it and get back into the normal course of equity refreshes. Ali, perhaps just from your side, as you look at things, maybe from a slightly different lens, what are your thoughts? What in the IPO process perhaps should boards, perhaps ideally refresh in terms of getting ready for this new opportunity, public disclosure, investor scrutiny, retention risks? Do you have an example that you could share here?
Sure. And I think to echo both comments by Steve and comments by Jack, like it is important that the board, the comp committee, not be looking at where the company is right now, but looking out into the future, right? 6, 12, 18, 24 months, and measuring the comp through that period of time. And right, I think that for a lot of private companies, there can be the mindset, particularly with the employee population, of we just need to get to an IPO. And the reality is you need to get to the IPO and beyond. And for most of those employees who may think that their IPO is it, they're going to be subject to a lockup. And so, right, a lot of it is also making sure that expectations are set correctly, so that folks aren't disappointed. And right, the importance of making sure that you're right, probably sounds counterintuitive to be granting more equity prior to the company being public, but to Jack's point, it's an opportunity. Right? Presumably your equity value at that point will be lower. And you also want to make sure that you don't have your most key talent fully vesting in connection with an IPO. And now you're in a place where you're scrambling because you have no incentives and you're having a very different conversation at that point. I think, to address your specific question around disclosure, investor scrutiny, I think, one of the comments that Jack had made about bringing folks on to the board, one of the strategies I've seen that's been really pretty successful from my perspective is companies that are bringing on directors, some of whom have been executives at companies that have gone public, right? C-suite executives who have lived and gone through this process successfully, who can help guide other directors around pitfalls, what to expect once the company is public, really raising awareness around the fact that as a public company, every comp decision you make with respect to your executive officers will be out there in the world and will get judged, even if you have, which, certainly for tech companies is expected, dual class and no issues around voting and election of directors, that scrutiny will still come. Followed by, potentially negative recommendations for directors. So it's really just making sure that folks are aware of potential implications in connection with their decision-making once the company is public.
Hey, Eric, just to add on to something Ali just said that I think is really important on this, getting the right directors on the board, it really is important. And specifically, I actually think the best person to chair a comp committee is probably a former sitting CEO, right? Because they're living it and they're experiencing it. Former CFOs can do it, but I think a CEO has kind of the vast group of people that they have to manage compensation for. So if you can get that on your board, and look, those people are hard to find, but if you can get that on your board, I think it really helps with the compensation process.
Jack, just building on that, in your experience, when do you typically see a private company start to recruit kind of that more professional external director leading up to the IPO? What's the typical time frame that you've seen in your experience?
Yeah, I think, I tend to be the first on my private companies. I tend to be the first independent director that comes in. And I often like to say I'm kind of the bridge between the investors and the employees, right? I try to placate everybody. So you tend to see someone like me come in because I'm more audit committee, and that's what people think of first when they're getting ready to go public. But the list of things that you have to do from a compensation perspective is just as comprehensive as what you've got to do from a financial statement perspective. So, as an example, myself and Michael Hurlston both got on the Astera board right around the same time, and that was probably a year before they thought they were going to go public. It ended up being 2 years before we actually went public. And Michael's the chair of the comp committee, and he does a wonderful job because he lives this stuff every day. So look, I think you're always looking for great people, and it ends up Michael's also incredibly good in the semiconductor industry, and that's the added benefit you get with him. But when you can pull those people in, you just grab them, right? I just think investors actually understand that you get those people when you can.
Yeah, the recruitment side of that is crucial. I'm sure that happens very much on the early side as you're thinking about the planning process.
Yep. And one of the things that I'll say, and Steve would love any thoughts that you have on this topic too, but when those people are brought in, it can often be a conversation that happens around their compensation, which can, in some instances, be a bit outsized relative to, it's not uncommon for directors at private companies to not get paid at all. And I've seen situations where private companies had a late stage private company had an opportunity to frankly bring a superstar director onto their board, and they gave them a large grant, and it turned out to be a fantastic decision for the company because, as Jack had mentioned, in one instance, this person had been a CEO of a company that was, had gone through an IPO process and very successful, but able to really be a partner both to the CEO and C-suite of the company on the operational side, but also understanding now in the director role, kind of all of the operational hurdles, decisions that need to be made, like the threads that need to be pulled together, but also, right, able to wear multiple hats effectively.
Yeah, that's a great point. I think, if you compare it to the public markets, right? Public market director pay is in a very narrow lane in terms of quantum and structure. You typically have 3 tiers: small cap, kind of 150, mid cap, 250, 300, large cap, 450 in terms of total comp. But in the private markets, companies are much more willing to pay up for director talent and experience. And that's where you tend to see more outsized pay packages on the equity side. And even if you're thinking about coming in a couple of years before IPO, typically the director pay compensation is, again, a multi-year equity grant. And then it's about transitioning to the public markets and what's more common and more traditional. But yes, definitely see more differentiation within the director pay sphere in late stage private than you would in the public markets, obviously.
Yeah, and I'll take it from a director standpoint. I'd much rather go into a private company that I know is going to go public because I'm going to make more money off of it. I'm going to put more work into it. I'm going to help them through the process. And I don't care about getting cash when I'm a private company director. I care about having a significant ownership stake in what we're building.
Yeah, absolutely. And that all makes good sense on my end there. I think one question that might help us pivot a little bit coming in here from the group, and perhaps related as you get really up and close and right at IPO, in terms of what do we think it looks like in terms of engaging with those proxy advisory firms, ISS, Glass Lewis, on the comp strategy and structure before rolling a plan out? Is that something you think need to do as you're getting ready to go IPO, or you have time, can wait and have a few years to buy yourself some time there?
I'll do the plug for my other two panelists basically here. I think if you have the right compensation consultant and the right lawyers, you don't need ISS Glass Lewis up front. And we could do a whole session on ISS Glass Lewis, which I prefer not to do. But I think you get the right advisors around you. One of the nice things is companies now are much more, obviously we have lawyers from the beginning, right? But we're more apt to get someone like a Steve to come in to a private company many years before we're actually getting ready to go public. And that is a very good practice. If you have a company that is doing significant revenue, you want to get a compensation consultant, both for the relationship, but also for the fact that they're really going to help you shape these things. Because as I said, there are so many things that you have to go through comp-wise, right? Like, I can't tell you how many times I've explained what a 10b5-1 plan is to founders of a company and why it's important. And as Ali knows very well, and Steve, too, those things have changed quite a bit in the last few years. And they're an important part of creating liquidity for your management team, but also they're important protections for these folks so that they can get that liquidity. There's just a lot of stuff that goes on. And I think compensation consultants, lawyers are a really big part of that.
Yeah, I agree
Did I
with
do a
that.
good job of pitching?
You did.
All
I would
right.
agree with that. I would agree with that 100% because I think for me, it goes back to that ownership profile. A lot of companies that end up going public, ISS Glass Lewis, they're not even a part of the conversation until a few years post IPO, right? What really matters is what's the pay program that's going to support your business and make sense for the economics of your business and the human capital of your business. And that's not an ISS or Glass Lewis question. That's a strategic question.
And I agree, Steve, with you completely on this point. And I often will advise clients too that you really, especially if you're not yet even public, right? There are certain types of comp programs that they are so far beyond expectation that if you were to put them in place, you then run the risk of potentially impacting company stock price in connection with an IPO. But those are so far removed from the norm that I don't view it as really worth spending a lot of time talking about. But on the ISS Glass Lewis, I think it's important to understand how they work, how they run, but you've got to focus on what's best for the business and not let that tail wag the dog, particularly if the company ends up as dual class. Again, ISS Glass Lewis, they don't like dual class, but it also means that you may have some negative recommendations in connection with your directors once you're public. And certainly if you're an emerging growth company, you're not even going to have say on pay or say on frequency for a number of years post IPO. And so it's, I think, important to understand the role that they play, but not let it dictate what your compensation program looks like, because not surprisingly, when everything is up and to the right, ISS and Glass Lewis have a much right there. No one's actually listening to what they're saying. And right, there's a correlation between pay and performance I say pay and performance, but if the company is really doing well, ISS and Glass Lewis can try, but they're unlikely to get a lot of traction with voters.
One other thing I'd point out here that would also tell you that ISS and Glass Lewis is not very important when you go public is think about what you're doing when you're doing an IPO. You're doing a float of a public shares, new public shares. That's probably going to be about 10% of your shares, roughly, right? So by definition, that means 90% of the rest of your shares are actually controlled by what I call friendly people, right? It's going to be your investors, your private investors, your founders, et cetera. So they just aren't as relevant until you get a real float out there. So it's good to know them, but I don't think it's that relevant to the IPO process.
Yeah, and Jack, to your point about founders, investors, et cetera, it's very likely that these are right. They're mostly folks sitting around the board, and so they are very familiar with the rationale and the story from a comp perspective.
Yeah, I think just reflecting on those comments, you hear a lot of do what's most important, what's right for the business. And Steve, I might come back to you there as you think through doing what's right for the business. How do you think about advising clients in terms of, creating that scalable compensation philosophy that you mentioned, balancing that the pre-IPO retention with developing into some of those post-IPO optics?
Yeah, I mean, to me, it goes back to, and I'll maybe try and tie it into a couple of the questions here in the chat, but it goes back to just business economics and what's right for the culture, right? So, if you think of the transition from private to public, board pay typically goes from all equity to cash and equity, and then pay for committee service. Executive comp, typically you see an uptick in cash, and then you see annual refresh grants on equity. That's the general play model. But for example, just a couple of examples of clients of mine work with a large SaaS company 8 years post IPO. They're still well below market on cash compensation. They actually pay out bonuses and equity and focus on the equity component because they believe, one, it's retentive, and two, that's where the wealth creation opportunity is. Another example is from a director standpoint, no pay for committee service, just get cash and an equity retainer. A little nuance, but the rationale for that specific company doing that is they don't want compensation to get in the way. They want to keep it plain and simple and really have the business focus on the business itself. And so while it's a small nuance in terms of director pay, there's messaging throughout the organization that helps to reinforce that. And then, finally, another nuance that just comes top of mind on this for me is companies will make that transition from, typically, at least in technology companies, from stock options to RSUs as your 409A value creeps up closer to the preferred price. And most companies at that time will start to transition to dollar-based grants versus fixed number of grants. Well, I have some clients who have actually stayed with fixed grants in the public markets only because, again, it's part of their culture. And so just to answer one of the specific questions here of what structures do you see, tech versus non-tech, I think the biggest difference, putting magnitude aside, is really the use of options within the general industry versus within tech. Tech moved away from options primarily. There is some corner cases, 10, 15 years ago. It's mostly about value delivery in today's world. And so I think that's the biggest difference is general industry will tend to have a little bit more option use and will be a little bit more prone to quote unquote the ISS Glass Lewis model versus tech is, I think, a little bit more creative in terms of how they structure their compensation to, again, attract and retain the best talent in the world to develop the next leading company.
That's great there. Yeah, and I think that makes particularly good sense just so you think about the different structures there. Perhaps kind of continuing to piggyback on that, as we think about, like looking at the transition, and Jack, you touched a little bit about the committee structure. How do you think about in terms of ideal compensation committees to think through IPO process and beyond? There's a question about, you know, former CHROs being on the comp committee. How does that sort of fit into your perspective as well?
Well, look, I believe that board members are generally good athletes, first and foremost, right? So you want to be someone who can cover multiple parts of what the company is doing. I'm not going to be the go-to-market expert maybe for a company, but I may know the industry really well, all right? And so for me, I look for the right athletes with this exception of you probably need a CFO and you probably really want to get a former or sitting CEO, right, as an independent. CHRO, it can happen, but you're going to have to really understand the business side of things. We're not going to bring in a CHRO just to run comp because that's what I think a CEO can actually do. But if they're the right person and they maybe know that industry that you're in really well, and maybe they know the people and team in that industry, then it can be a really good addition. But I don't find that we look We tend to look for the athletes, not the specific sprinter.
And
Absolutely.
Eric, I'm happy to chime in. I see that there's a question around
Absolutely.
investors and proxy advisors evaluating compensation. Sorry, I'll read it. So how do investors and proxy advisors evaluate compensation practices in the first year after an IPO? Are there particular red flags committees should anticipate? So happy to take that on. And then Steve, obviously chime in. I guess a couple of things to understand. The first is that if the company going public is an emerging growth company, which most are, there will not be, right, there won't be a say on frequency or a say on pay advisory vote for a number of years, likely post IPO. And so what that means in terms of proxy, and I'm separating out investors and proxy advisors really to focus on the proxy advisor side because, with investors and if you're, headed down a path of sort of investors activism, that is number one outside of my wheelhouse. And number two, you're going to need something very extreme, I think, on the comp side before they start jumping in the pool. But on the proxy advisors, the things that they, again, where they provide reviews of proxies and recommendations is in connection with director elections and whether or not they are supportive of directors who are up for election. So that'll be, it could be as soon as your first post IPO. In that instance, they're unlikely to, and assuming that you don't have a say on pay, say on frequency in your proxy, they're not going to be picking apart your compensation. That being said, if you have, problematic pay practices, they might. And what do I mean by that? There are certain things that ISS and Glass Lewis don't like, regardless. 280G gross ups. So things that are really viewed as poor pay practices. But even at that, you're more likely to draw a negative negative director recommendation for a governance practice before you get it from a comp perspective in the first few years. And really, a lot of it all unfortunately kind of comes at once for companies that have an IPO and the stock is up and to the right. Nobody's really popping the hood, right? They might, just making sure they're going to kick the tires. But it's when companies are not doing well that then they're going to look to see, is your executive team being paid too much? Like, are there other strings that they can pull on, threads they can pull, to test the comp programs and really test the overall governance of the company.
And this is where getting a compensation committee in place early really helps, because there are certain things that I would just say are bad governance, right? So Ali mentioned 280G gross up. That should never happen. That's just not a good thing, right? That's not in the interests of shareholders broadly. And you're going to know that if you sit down prior to an IPO and you listen to your lawyers and you listen to your comp consultants. They're going to tell you the things that are, kind of on the line where you can make some decisions, or really off the line. And if you really care a lot about that, maybe that's the one you want to go for. But, be aware, eventually you're going to have probably some problems with it down the road. And so I think, there's really is a true difference between governance and good governance and frankly, just a rational decision to make the business work. I would just say two other things, or one other thing in particular on proxy advisors. Again, remember who your audience is. So you're newly public, you probably still have control of the shares. If you're dual class, you definitely still have control of the shares. It doesn't give you an excuse for bad governance, but know that the impact of those people are probably less in the first couple of years. And I will say I am not a fan of dual class stock. I do not like it. I think once you go public, you're making a decision that you have shareholders that should have the same respect that you have for all the existing shareholders. However, if you're going to do it, you just need to keep in the back of your mind that it does change your decision tree probably a little bit.
I was just going to build on a couple questions related to kind of timing of, and one thing you said, Jack, of kind of, establishing a committee early and a process early. I think that's a big thing. And to Ali's point, looking around corners is extremely important. So I think there's two questions in here. From my perspective, we typically get involved normal course a couple years before an IPO, at least. That at least gives you 2 cycles to get your charter intact, your process intact. And I think those things are important in terms of a muscle, because once you do go public, there's going to be issues that come up that you're going to want to rely on that governance and that process and decision making muscle of the committee. In terms of the other question in the chat around when you bring on, I guess, less friendly directors, in my experience, it's around the same time, maybe a little bit earlier than what you would do with a comp consultant. So around that 2-year mark, I think, is when I typically see independent directors start to come in. And again, it's just uplifting that governance and decision making, especially if you're making outsized decisions. For example, we haven't touched on this, but founder awards or big equity refresh grants, you typically want to have a number of independent directors around the table when you're making those decisions versus a very small contained board.
Sure. And, one other thing that I wanted to add too is that I think that an overfixation on an ISS Glass Lewis proxy advisor, right, their input once the company too early post IPO or even before the company is public can lead to the company putting in place performance-based equity awards when the company really doesn't need to, and also doesn't have a good enough sense of the business itself to put metrics in place to understand how best to measure success of business beyond just stock. There are a lot of ways to measure performance within a company. And I've seen all too often companies that are newly public who feel this pressure that frankly they're putting on themselves in some respects, or sometimes there will be suggestion that, hey, we've got to now put performance-based awards in. You don't need to do it right away. And not doing it right away, there will come a point in time where ISS and Glass Lewis are looking at what you're doing, and that's a great time. And you want to have something in your pocket that you can then, the card, you don't want to play your card too early. You want to have it in your back pocket to play, and will also give you an opportunity to understand, as a public company, really what is driving the business and what are the levers that should be tied to vesting of a performance-based award.
Ali, I think that's a great point. That was one of the things I identified as one of the risks post IPO is companies putting too much emphasis on trying to put in performance-based equity either too early or not thinking through the different variations of what that could be and what that means for the organization. Now, for example, making the switch from a RSU program to a performance-based program, well, there's naturally a trough in earnings for some of the executives. To your point around, well, what do you actually measure, and can you actually look out 3 years? Do you need to actually look out 3 years? All those questions are big questions. And I think, at least in my experience, doing that, once you've got the IPO and your kind of things have settled, the lockup period. So post IPO, 3-4 years, again, back to Jack's comment earlier on, know your investor base, kind of know you've got control of the shares. You don't need to do these things. You need to do what's right for the business, given the context of the macro environment more than anything.
Yeah, one way to simply put it is PSUs sound like something we would all align on, but you have no idea how hard it is to do PSUs. Your world, think about how your business changes on a daily basis. And now you're doing PSUs for 3 or 4 years, on goals over a 3 or 4 year period. Very hard for a newly public company.
And right, if you were to put in a PSU too early, and most PSUs have performance periods of 3 to 4 years, and if you think about the IPO timeframe, that 3 to 4 years out is right about the time that you're likely to become a large accelerated filer, subject to say on pay, say on frequency, all of that, which means ISS and Glass Lewis are now looking at what you're doing. And really one of the worst things that you can do as a company is pay out an award, use discretion to pay out an award that wasn't earned. They'll hammer you, the comp committee for that every time. And I say every time, with the exception of a global pandemic, there was, right, during COVID, a one-time pass for companies' adjustments metrics. general proposition. You really need to get it right, and it needs to be this like Goldilocks is difficult to achieve if the business hasn't had an opportunity to just function and settle as a newly public company.
One topic that I was thinking we could circle back on a little bit that was brought up is just around the piece of the founder awards. You know, we talked about let's do what's right for the business, and there's less concern immediately from proxy advisors. What are we seeing in terms of potentially large front-loaded founder awards? We saw a handful in the prior IPO market, so to speak, back in 2020, 2021. How's that changed now, and what's the appetite for continuing to do that going forward?
I still see more of it than I would have thought. But it's also, right, like has a lot of curb appeal for a founder, the I want this award. And interestingly, in the conversations that I've been involved with, the awards all end up getting structured so that if every metric is hit, right, they're typically, these awards are outsized, often subject to multiple tiers of performance that has to be achieved in order for the award to actually be fully earned, vested. Sometimes they're RSUs, often they are options, but it's interesting to me because one of the consistent themes is that at the bottom line on the assumptions, if the award is fully earned, it results in, $1 billion plus in value. And then you kind of work back from there. But so I've seen continued conversation around these awards, obviously from a legal perspective. If we take nothing away from the Tesla litigation, you got to be really careful and make sure that you're documenting things, the discussions you're having. Important to have Steve producing information and making sure that the decision to head down this path, and not to say that companies shouldn't be granting these awards, but I do think they need to be very careful about properly documenting the discussion, the analysis, and again, going back to the question that had been asked about less friendly, making sure that it is properly documented, vetted, et cetera, so that there isn't an argument down the road if the award hits and is worth a lot of money, that now you've got a problem that the decision, wasn't made. There was influence by controlling stockholder, whether or not they actually control the company.
With that, I think from my perspective, I agree with you, Ali. That certainly part of the conversation. Certainly with the IPO market opening, more and more uptick both in the private markets and the public markets. I think the difference, if you go back to 2018, 2019, 2020, when there was a lot of this going on as well in the pre-IPO market back then, I think the difference between then and now is then everybody was doing it, and everybody thought that it was a significant wealth creating event, but then the market collapsed, and a lot of those awards were worthless, etc. I think from a director standpoint, in my experience, the directors have gotten a lot better of asking the question of why. Why do you need to do this? What's the intent of this? What are we trying to accomplish this? What is the broader context that makes sense for to do an outsized award? And I think that's the conversation, back to a theme we've talked about, of having the committee set up early on, having those conversations early on, because that typically, in my experience, starts to happen a couple years, even if you don't make the grant up until the time of IPO. The conversation is happening over multiple years and doesn't actually make sense.
I think something to think about here is, look, in general, I'm not a big fan of these outsized grants to key individuals, particularly because it ends up being like key individuals instead of broader people. And as we all know, it takes a lot of people to run a company. And so by definition, you're probably taking away from other folks because you can only have so much dilution over time. I think one of the things people don't think about when they think about these big one-time awards is what happens when they don't hit the milestones. Okay. And that's something to really think about carefully, because you're setting an expectation for that executive that you want them to hit those milestones. But when they don't, do they come back and say, well, I got 3/4 of that, or, there was a pandemic, or, I think you have to be very, very careful, because you could end up rewarding people for behavior that is nowhere in line with what you were trying to do. And I don't like that. I don't think it's right for shareholders personally. The way I like to look at it is, particularly with like founders, is what is the right level of ownership for a founder going into an IPO, right? And if maybe those founders haven't gotten grants for a long time, then I think it actually is the right time to come up with the right level of ownership and then incent the behaviors that you want with it. Like, I want you to be around for 5 or 10 years. So maybe I have longer cliff vesting or just things that encourage you to do what we think is right for the company, right? But at a level that is a normal level of ownership for someone in that position. So that's kind of the way I like to try and rationalize it. I think it's very common when you're going public, and you should all be prepared for it, that you're going to get founders or CEOs or executives on the team. They're going to come looking for some compensation. And there's nothing wrong with that because you can give them what is lower cost compensation, and in hopefully get them incent the right behavior going forward that's good for all the shareholders. But when you start getting disproportionately large, that's where I start to really struggle with it.
That's great. I like.
Your comment, Jack, on it not working out or not achieving the milestones, is one that rings true to me. You think of retention awards or any sort of IPO reward. If it doesn't turn out the way you want, even if it's not in the executive's control, it might be a macro thing you pointed out. What do you do then, and what message does it send to the organization if you replace it or if you modify it, etc. Right? There's a lot of issues that come up with it.
I mean, this goes along with the PSU conversation we were having, right? So
Yep.
this is why it's better to take some time and know your business and then do these PSU type things.
Yeah, so I just want to make sure that I answer a couple of the last few questions here. One perhaps a little bit outside of the pay program. We talked a lot about equity grants and setting it up for making sure people are staying for a long time. Is any other methods that the group has seen in terms of retaining employees outside of just normal course equity grants that are put in place?
So Steve, I imagine you have quite a long list, so I will just chime in with what I've seen. I mean, if you're not using equity, then I've seen cash also, right? And it's hard because I think that for some companies who thought that they were going to, in 2021, for sure thought they were going to be public and found themselves on the wrong side of an IPO window in 22, and still they're still sitting in that spot. It's hard because as an employee population loses faith in the value of the company's equity, they've got to do something. And other than, I guess free food and perks at a tech company, right? It's going to be cash, which is also not first choice either, because for most companies, use of cash in that context is not highest and best use of cash.
Yeah, I agree with that. I mean, corner cases, you might see mission, right? What's the company's mission, and that has some weight to it. Titles I've seen used, and then the last thing is just severance or change of control protections, sometimes used in replace of equity.
That's a great set. I've got nothing to add.
And we spoke a little bit about going back to the founder piece about the shares and the voting power. Specific question here about how that gets set up, just in terms of from the governance perspective.
Well, when you go public, any preference that a founder shares might have are going to go away unless you're going to have a class of shares, right? So you may have a class B common, and that might have significant voting, but it's going to be everybody in the class B. You're not going to see, well, you could see, I would call it very poor governance, a situation where you give one individual person or two individual founders maybe that kind of disproportionate pull on the company. It's happened. There's been some really bad governance stuff that's been done bad in my view, stuff that's been done in really the last 10 years where I wouldn't say this can't be done, but it's you're going to attract a lot of attention if you do this. And that will get noticed in an IPO, right? People will notice it and they will take it into account. And frankly, they'll look for a discount because of it. In my view. Going public gets you liquidity. That's what you get from it, right? That's a great trade-off in my view, right? Constant liquidity is one of the most valuable things you can get as an executive.
Perhaps maybe just time for one more question, and then I'll set it up for our closeout here. But just in terms of the benchmarking, as we're thinking about the IPO planning, you know, how are we thinking about that looks in terms of setting up the right peer groups, and making sure we're looking at specific sector, but also taking this to consideration the size of the company.
That one's right up your alley, Steve.
I would say it depends, right? Look, typical process that we would employ is usually a public company peer group. You might have two, one that's near-term IPOs, so ones that have gone IPO in the last 2 years, in that window that are obviously in the same sector and same size. And then your more traditional peer set that will look at, again, typically market cap and revenue, and then the economics of the business. Oftentimes as you're transitioning, I think, from private to public, what we'll do is, again, there's no perfect peer group. We'll look at multiple data sets. So we'll look at a private data set where it's only private companies, cash is typically lower, basis points is typically the focus point, and we'll dovetail that with the public company peer group, and we'll see kind of what that straddle or what that road looks like, and we'll make decisions with the broader context in mind. So that's our preferred approach, is to look at it from multiple lenses, not just one singular data point.
And I think, Steve, I'm sure that you've had this similar experience, but what I have seen as really a sticking point with founders is when you start talking about peer group, and for every founder, pick your industry, right? It's Apple, it's Google, it's Meta, those are their peers. And it's a conversation that needs to be grounded both in reality and setting proper expectation. I do think that it's not uncommon to have multiple peer groups, and it can be one peer group is the aspirational, one peer group is reflective of where you drawing and recruiting talent from, who is your pool for talent to grow the business in the future. And I've seen, usually founders will start to get comfortable once they understand that no one is telling you that your business, it won't someday be Apple, Google, Meta, pick your company, but that in fact, right, it is for governance purposes. It's important that it's done on an objective basis using these measures that they often don't like.
Yeah, I agree with that. I mean, at the end of the day, it needs to be defensible once you are public, right? But the reality is the talent market for some of this executive, talent that might be critical might be coming from a much larger organization or a smaller organization, and making sure you have that full context when you're making the decision is important.
It's almost like you guys have been through this before. Yeah, no, we all see this. Peer groups are actually really important because they're kind of the foundation for doing all this analysis. So you really, if you're on a compensation committee, you need to spend time on these peer groups. I think this gets back to a bigger point that I know the other panelists would agree with. One of the most important things a comp committee can do, either while they're private or while they're going public, is establish a philosophy on how we operate, right? We pay at X. We believe that our comps are going to be aspirational, or they're not going to be, or they're going to be just whatever it might be, because every company's different. Because in the end, once you get to a point where you're doing say on pay and you've got to deal with ISS and Glass List, look, they have their own peer groups for you, right? They're going to look at yours, but they're actually going to come up with their own. And so if you're radically off of what they're doing, it's probably going to raise a flag that you don't want to have raised.
Great. Well, so I see we have just a few minutes left, so I might just see if, as we wrap up, just ask each of our panelists quickly, final takeaway and or question perhaps that a board member could ask at their next meeting, just as we reflect on this discussion.
I'll give a takeaway that you should all be aware of. One of the things that the panelists have mentioned is that we've moved in tech away from stock options to RSUs in the private company environment. In fact, many companies are doing RSUs way, way before they go public now. In some senses, founders love it because there's less dilution. Investors like it because it's less dilution. But don't forget the consequences of doing that. And what I mean by that is generally, if you're doing RSUs, you're going to do double trigger RSUs that require a liquidity event for them to actually vest, which means you are likely to have a boatload of RSUs that are going to vest at your IPO. And so that creates a variety of issues. It creates an issue related to stock-based comp that you're going to have to recognize at the time of the IPO. And I've seen it where these things are very, very meaningful percentages of revenue, particularly in the quarter of which you go public. It also creates tax issues. You're going to, depending on how you settle these, the company might be paying out a lot of cash. It could be a good, I had a company went public recently that we actually cited this as one of the uses of cash for the IPO. So just make sure you're thinking through the impact of those decisions and how an IPO might trigger some of that.
And I think, Jack, can't stress the importance of that point enough. You need to understand that outcome when those RSUs are being granted. I have had companies, end up, where I'm advising, and it turns out that they didn't have those conversations at the time they were putting RSUs in place. So they've got an RSU program with, frankly, vesting that's tied to an employment commencement date, things of that nature, which means if you've got RSUs that will potentially be vesting every day of the year, post-IPO, you're going to need to hire another person to administer the settlement and tax withholding on your RSUs. So it is really important to make sure that those RSUs are put in place thoughtfully, and with advice from myself, from Steve, comp consultant. And to Jack's point, I similarly worked on I think it was just last year, and one of the S1, one of the uses in the S1 was income tax withholding in the hundreds of millions of dollars. So it is often a material issue, particularly for the IPOs we're starting to see now, which reflect a backlog of a couple of years.
Not much to add. The only thing I'd say is, as we talked about, start early. I don't think they're early enough is too early. Look around corners. And I think to Jack, to the point you made, is be planful of when things don't work out like you might think they should, right? What are you going to do in that scenario, in that circumstance?
Great. Well, I see we're at time. I just want to thank our panelists so much for the discussion and their insights, and the group as well for including the questions. And good luck to everyone with your IPO planning for the rest of the year.